Hello and welcome into the KE Report. Shad and Corey here live at the New Orleans Investment Conference, and we're sitting down today with Dakota Gold. Dakota Gold is traded on the NYSE American under the ticker DC, and we're joined today with the co-chairman and director of Dakota Gold, Bob Quartermain. And Bob, it's great to see you in person. We last chatted in Beaver Creek, and we are long overdue for an update here at the KE Report on Dakota Gold. We last had you on the show officially back in the summer in June, and we were talking about the resource at your project in South Dakota, the Homestake district coming back alive, and really this resource was at the Richmond Hill project. And so just as a kicking off point, let's remind people of the size of this resource that you have growing in South Dakota.
Great. Thanks, Shad and Corey. Great to be here. As you point out, the resource we've outlined at Richmond Hill is one of the largest undeveloped gold resources in the United States. So we have 3.6 million ounces of measured and indicated gold and 2.6 million ounces of inferred gold with a substantial amount of silver. So, of course, starting my career in Silver Standard, it's always great to have that support from silver within it. And we completed that in February, and it was based off of 900 historic drill holes plus the 150 drill holes we put into a very robust resource. And, of course, we're located only 2 miles north of Core's open pit Wharf mine. So it's an analogy to that mine. So it's kind of a brownfield project in an existing mining camp.
Diving into some of these numbers a little bit more, everyone always looks initially at the initial capital costs in here. Under $400 million. Talk to us about how quickly this can be built. And quite frankly, for the NPV that you're looking at of over $1 billion, it's not that expensive of a build. So what goes into this?
That's correct. You know, the fact that we're located next to an operating mine allows us to be really efficient with the capital. So although we've done what you call an SK 1300 IA with cash flow, similar to a PEA, the numbers are very good because we're able to use the operating costs from the core mine to make our initial assessments on it. So to your point, capital costs looking at about $330 million with a $50 million contingency to bring us up to $384 million. We're looking at a 30,000 ton a day operation. So between the equipment we would need, the mill we would have to build, they're all very well known from operations, let's say in Nevada. So it's kind of almost off the shelf. And the fact that we're about a 15 or 20 minute drive from our office in Lead, South Dakota is really a great opportunity for us. We've got infrastructure there. You get really good access to where the project's going to be with respect to Richmond Hill. And so that really helps us keep that capital down. We can actually bring people in and perhaps put them up in hotels. You don't have to build the expensive camps that often more remote sites would have to do. So all good, and that certainly informed the capital costs that we did. And we're using M3 as our consultant on this, plus other consultants who inform data to them.
Well, Bob, just to that point, one of the critiques I've heard is that it seemed too low to build this, and I think it's because people aren't used to people being able to drive to work from nearby towns. So maybe talk about that common misconception that because the CapEx is so low, it's just because there's so many things working in your favor at this project.
That's right. Like you say, you can actually drive to the project from the office. Power line is close to it. As you know, the last project I was involved in building was the Bruce Jack mine for Pretium. We had to put in a almost 100-kilometer power line. We were 6,000 feet up in a glacier. So this is the antithesis of that. People can drive to the operation. And again, because it's a heap leach operation, that technology is well proven, it's well understood. And because the 30,000 ton a day that we're looking at operating, it's going to be able to get and source that equipment which we need for it. And as I point out, next door, Core's Wharf mine has been operating now for over 40 years, produced over 4 million ounces of gold. They produce about 100,000 ounces a year. And so we've got a really good template that we're able to utilize in that regard.
Now, if we're looking at the average life of mine here, the annual gold that you would produce, or at least payable gold, we're looking at 153,000 ounces. At all-in sustaining cost life of mine of little over $1,000 an ounce. So, question for you, any way to make this bigger so that you could, in a way, almost cut down the mine life? 17-year mine life, what about going bigger with this thing?
That's something we're currently looking at with our feasibility study with respect to trade-offs. The one benefit that we have with the Richmond Hill project, it's on private land. And as a result of being on private land, we've got a fairly consistent timeline that we can go to develop it with respect to doing our feasibility work, which is supported by the baseline work that we're currently working right on at this point in time. So we're in a 3,000 acre. We find that the optimization, let's say, for ground disturbance is somewhere around 580 acres. So our plan is to do concurrent reclamation as we're doing mining. So that allows us to basically take that long mine life, and as you say, as we mine it, we're able to reclaim the land going forward. So we'll certainly in trade-off studies look at being able to do that, but we also want to minimize our disruption on that environmental footprint within the 3,000 acres we're operating on, and that helps inform that timeline that we're looking at for the project.
Well, just another thing that jumps off the page at me, Bob, is that the metals assumptions used, gold $23.50 an ounce and silver $29 an ounce. I think most people listening to this call will realize we're at a little bit higher metals price than that now in both metals. So how does that factor into how people should value this project?
Well, I think if you look at our company, we have 112 million shares outstanding. We trade around $4, so about a 450 million market cap. And as you point out, when we did the SK 1300, we did use a $2,350 gold price, which gives an after-tax net present value for a measured and indicated case of 1.6 billion. And if you look at the measured and indicated and inferred, about 2.1 billion. If you look at current $4,000 gold prices, then of course those NPVs go close to $3 billion. So it shows that by execution over the next 4 to 5 years as we bring this into production and limiting the amount of capital that we need to spend, we can really provide good torque for shareholders in this kind of gold environment. So that'll be our focus, continuing our drilling, getting it finished off, move into full feasibility, into permitting, and then see this kind of very robust rate of return. As you point out, at current metal prices, the rate of return is almost 100%. So it's a pretty attractive place to be in this gold environment.
Yeah, that's why we're seeing a lot of companies try to fast track production, get in production here and now to take advantage of those higher metals prices. There's only so much you can do in terms of the timeline here with feasibility for early 2027, construction 2028, production targeted for 2029. When does financing this build come into the picture?
So once we have our feasibility study completed, at that point in time, I think we would look to source a kind of financing we're going to need to be able to put into production. You know, Orion is our major shareholder. I mean, Orion's our largest shareholder. I'm the second largest shareholder in the company. And when we did the financing with Orion, the one thing they offered to us is to look up to do upwards of $300 million of the project financing that we'd be able to do. So we're in a unique position that we have a major shareholder who certainly has the bandwidth to be able to do the financing. And I've got that experience from the time up at Brucejack when they funded the Brucejack project into production for Pretium. So, you know, we can start having those discussions in 2027 once we get through feasibility study, have the document to know exactly what the capital costs are going to be, and something we can use as a bankable document. And so with it in hand, you know, we'll look certainly at the opportunities that Orion can provide us. You know, with the increase we've seen in share prices, you know, equity is often another component to it. And of course, we've got a silver component here that is not germane to the project, but, you know, looking at some type of stream off the project could certainly reduce the overall dilution shareholders have to take. So lots of flexibility, which is I like with respect to financing opportunities, as you point out, as we move this through feasibility permitting and on into construction.
Well, Bob, I just got to ask you what a lot of people are probably thinking with the Wharf mine being so close with core mining, any synergies there to potentially fast track things even more?
You know, at this point in time, I don't think so. As we know, Core's got itself quite busy with some recent transactions it's undertaken. We certainly have very good relations with them as neighbors. I think the key thing we want to make sure is we don't compete with talent too much and be able to bring in the talent that we need going forward. Our operation will be a little bit different. Core basically takes their heap leach material, puts it on a pad, and then removes it off. Our position is to have longer term pads where we're going to put our mineralization down. The only thing is, of course, we've got this kind of the same access road we go by to get to our project going by the Wharf mine. But other than that, it just being good neighbors with the other operating mine in the state and in the district.
One more just financial question in terms of sustaining capital. That's only $219 million and a little bit of change on that. That all internally funded once this is up and running?
You're right. Once we look at getting up and running and producing 150,000 ounces a year. When you look at those margins of our all-in sustaining costs of $1,000 with current gold price, we'll be generating a lot of free cash flow. And the plan would be that those monies would go first to ensure we've got sustaining capital, perhaps to do some additional exploration in the area. But, you know, we as Dakota Gold have the largest land package in the historic Homestake district. We've got 48,000 acres, of which we have, you know, about 14,000 on private land where we have both Richmond Hill and our Maitland project. And that kind of cash flow is going to allow us to focus that cash on the other opportunities that we have in the district.
Well, just on that note, let's talk about some of the blue sky potential here. You've got a drill program that's 27,500 meters that you've mostly completed at this point. I think you mentioned off mic here that you got about 40 holes at the lab waiting for assays, but you're still drilling. You probably have more drilling. So walk us through what is still left in that program and how this feeds into the resource growth.
Right, as you say, we've got ongoing drilling, so that catalyst will come out over the next few months as we report our drill results. We've been very good at doing that kind of every 3 to 4 weeks as we get batches of holes coming in. We've also been doing some preliminary metallurgical work with bottle roll testing and column testing, which informs a much larger metallurgical program. So we'll continue to have data flowing out from our Richmond Hill project here in the fourth quarter, and that will set us up getting all the data we need for the feasibility work by providing us with the baseline work that will help inform the resource that we have that we'll use for feasibility and potential for further growth on that resource, because we're now drilling in areas which are currently outside the current resource model. So we're very excited about some of the results we've seen to date, where we're getting upwards of 1 and 2 grams over very wide intersections, which is substantially higher than our planned mineable grade.
Now, could these results change the overall mine plan then? Because I believe your average head grade for the life of mine right around 0.5 gram. If you find, I guess, some deposit size of higher grade, does that totally change these economics?
No, I think it would augment to them, Corey, because of the fact that we're actually planning to mine in the northeast corner of the property, and that's where we're now seeing the higher grade. So all it will do, I think, will help improve that. Perhaps there's a little more gold you might recover in those initial years to pay your capital back. So we're excited about the fact that those are largely within the mine plan or can be easily added to the mine plan, because that's where we're going to do our initial mining from. But it's exciting to be able to get, as you say, some intersections where we're seeing 1 and 2 times the current mine grade, which can only help with payback in those initial years of operation.
Well, and if we scan back even one layer further on blue sky upside, let's talk about Maitland. Maitland is still sitting there as a giant at the depths there, and it's what initially attracted you to the project. We haven't really spent a lot of time on that here, but if you got this mine up and running, would the plan then to be to get Maitland going in sympathy with it?
That's right. The Maitland project, we have 47 intersections into what we call the JB zone. And the JB zone averages around 10.7 grams of gold over 4 meters. So very high grade. The historic mine averaged around 8 grams. The West Ledges, which is an analogy to what we have, it produced over 6 million ounces. And it did that from mineralization, which was around 11 grams over 6 meters. So we know we have something that's very similar to it, has multi-million ounce potential, and it's only 3 miles from the old historic mine, which produced over 40 million ounces of gold. So as you point out, as an exploration geologist, I was excited about that opportunity. It does require a lot more drilling to be able to get in and inform the resources we'd have, because we need much more detailed drilling. So it's great to have Richmond Hill as an area that we can get in, develop, and then use the cash flow from it to be able to do that detailed work, ultimately get down underground on it. But again, here the opportunity for shareholders in Dakota Gold is a near surface, a near-term opportunity with long-term optionality with respect to the high-grade mineralization in the old Homestake district.
So at Maitland then, give us the roadmap. How much work needs to be done? How much money do you think that would cost? And how long would it take to build up multi-million ounce resource?
You probably have to look at certainly a few years with a lot of detailed drilling, many tens of thousands of meters of drilling. You know, previously we spent about $40 to $50 million in that ballpark. I think we'd have to be looking at that kind of a budget. And again, that's the amount of money better informed by coming from an operation and diluting shareholders down at this point in time. We continue to evaluate with our geological team about other areas we can go in and get a little more information around it. We also have something we call the Unionville zone, where we have some higher grade oxide material near surface, We're looking at whether we might be able to drill that because it could augment some of the work we're doing at Richmond Hill. But the nice thing is we have optionality built into all these projects, which are only a 15 to 20 minute drive from our head office.
Well, and when we're talking about development stage projects, a lot of people want to know what's the permitting landscape. You're in a unique situation and where your project is positioned on the land. So maybe give us an update on the permitting process. What's that roadmap look like for Richmond Hill?
That's right. Because we're in South Dakota and there's been mining going on there for some time, then certainly the regulatory authorities are familiar with mining and the kind of heap leach operation that we want to do. It's what the process that Wharf is using next door. As you point out, because of private land, then we deal with the local Lawrence County regulators with respect to conditional use permits they have. And then, of course, we do much of the work we have to do around a larger mine permit comes from the state of South Dakota. So currently, there aren't any kind of federal regulations we have to involve, which means we can actually talk to the local state legislatures and regulators, determine what it is they would like us to do with respect to permitting, and then make sure we're doing that baseline work. So when we go and make our permit applications in a year or so from now, we've actually have the data that they'll be able to use to help us move along that tangent. So I feel very comfortable. As you know, I came out of retirement a few years to take this opportunity on, and one of the key things was understanding being on private land, that kind of well-defined, prescribed process to get permits in hand, because before I turned 75, it'd be nice to have this project up and running and producing gold for our shareholders, and we can certainly see that tangent going forward.
Yeah, you probably need to start some of that permitting work really soon. Some of the lag times on that are a year, if not longer, for some of that, all depending what you need to go through. What moves the needle in the near term for the company then? You have this resource, you have these economics out or cash flow estimates out, you're drilling. So then what news flow is the next catalyst for everyone to grasp onto?
I think there's two catalysts here, Corey. One is going to be continued drilling up in the northeast corner where we've been getting this higher grade material, so people can look and see, the mine plan is going to be supplemented with this new high grade, which we're drilling off in that northeast corner. And then second, the metallurgical work. The IA with cash flow projected recoveries around 85% based off historical work, which was done on the project. And so we're currently doing that work now to kind of augment and show that's kind of what our expectation will be. So I think with additional high-grade drilling, getting out preliminary metallurgical work that supports the recoveries, those would be two catalysts, because then people can look at this, i.e. with cash flow and the projections of it, and seeing this as a really robust project going forward. And those will be two. And then, of course, starting next year, it'll be working through the feasibility process.
All right, well, let's wrap it up there, guys. That's a lot of news on tap with Dakota Gold. Everything from drill assays to met work, working on permitting, working on de-risking the project, building towards the feasibility study. So for those of you listening in, definitely click on the link below in the show notes. It takes you right over to the Dakota Gold website, straight to their news section, where you can sign up for updates that hit your email inbox, or just follow along with the news as it comes out on the wires. Bob, it was great seeing you here at the show in person, live in the flesh, and let's get you on again soon, maybe a little sooner than last time, and looking forward to our next conversation.
Great, Chad. Great, Corey. Thanks very much.